This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at last, light at the end of the tunnel, we come to the last of the lectures on this first chapter so far as capital gains tax is concerned. The main area still to look at is that of chattels. Now, where we came across that word, as we said at the end of the previous session, was when looking at our definition of a chargeable asset, which said all assets are chargeable unless specifically exempted. And under the list of exemptions was a fairly, I suppose, useless list of item listed, which was certain chattels. Now, chattels are tangible, movable assets. The typical things that you see would be, as we spoke of in our first lecture, things like antiques, works of art, painting, statues, jewellery, items of that nature. Tangible, movable asset there. Other than anything else that, of course, that is specifically exempt, like cars are specifically exempt. They're tangible, hopefully movable, asset, not all the time. But if it's already exempt, then it's not an issue. But chattel, tangible, movable asset. Certain chattels are exempt. Which ones? Well, here's a new term that we now see, a wasting chattel. A wasting chattel, that means one with an estimated remaining life of 50 years or less. These are exempt assets. So nothing needs to, no other information needs to be told to you about what they're sold for, what the costs are, though all that information will be given because they're exempt, so there is no calculation to do. Now, your typical examples here, for whatever reason, but the ones most often used as wasting assets, racehorses, greyhounds, that's a type of racing dog there if you're not familiar with the term. But clearly, animals of that nature that have value, they race, they win things, well, more usually lose them, but they win things, they have value. Now, those are wasting chattels. And therefore, when disposed of for capital gains tax purposes, they will be exempt. And boats, usually yachts they're referred to, but boats in general. Those two will be deemed to have a life of 50 years or less, no more than 50 years. In which case, don't get sucked into doing any calculations, it is simply exempt. Again, though, you think, well, it's rather generous, how come that they are making these exempt? What do we say? We often see exemptions being made available where a disposal is in fact very unlikely in practical terms to give rise to a gain, but would rather more likely have given rise to a loss. So by exempting these assets, there will be no allowable loss available for the taxpayer then to set off against other gains. There is method, remember, in the madness of HMRC. And if you've got something whose life is going lower, then the chances are that its value will go down. Now again, that doesn't always happen so far as things like racehorses or greyhounds are concerned. You get the very odd exception where it does particularly well and its value goes up. But most of the time they will go down because at some point they will have no life and then they will be worthless. And boats. Again, what was it somebody told me once who had a boat? He said the two happiest days in your life, when you buy it and then when you sell it. Because when you sell it, you'll be glad to get rid of it. And sadly, of course, you'll make a thumping great loss as well. So very likely to see losses. So they exempt them. As I say, it's a sensible move on part of HMRC. We do have an exception here for plant and machinery on which capital allowances have been claimed. These assets are treated as non-wasting chattels, so they're not exempt. If plant and machinery is not covered by the non-wasting chattel exemption, that's what we're going to see down here. If the plant and machinery is not covered by the non-wasting chattel exemption, in Note D, then again would need to be computed upon its disposal. Now, although it could arise, in practice it's just not going to happen. Such a calculation is seldom required, however, as it would normally be sold for much less than cost. Is it at all likely that second-hand plant and machinery is going to be sold for more than you paid for it? So it is very unlikely that a capital gain would ever arise because you are likely to be selling it for significantly less than cost. So if you're selling it for less than cost, I hear you say, does that mean that you'll have a capital loss? Because if it's not exempted, then it's chargeable and therefore a capital loss. Answer, no. A capital loss will not, however, arise in this situation because we're talking about plant and machinery. Plant and machinery will have ranked for capital allowances. So we've already had tax relief through the capital allowance system for the net cost of the ownership of that asset. So we already have given tax relief for the cost of the ownership of the asset in relation to the capital allowances. So with such assets, therefore, it is very unlikely, though it is possible, that a gain could arise. It is impossible for a capital loss to arise because you've already had capital allowances. Now, by far the most likely category of asset for you to have to deal with in any exam question is the next category, dealing with non-wasting chattels. That is, of course, with an estimated remaining life of more than 50 years, hence the antiques, the paintings, the statues, the jewellery, where it's got some indeterminate life, but it should therefore be of more than 50 years. And that's why I gave you those examples earlier. There are special rules to determine any chargeable gain or capital loss, or indeed any exemption. So let's look at those disposals first of all that are exempt, as we see here. If it is bought for no more than £6,000 and it is sold for no more than £6,000, then it is exempt. There is neither gain nor loss. So if I buy it for £3,000 and I sell it for £5,000, both 3 and 5 are less than 6, in which case it is exempt. There would be no gain. If I buy it for 5 and sell it for 3, again both figures are less than 6, there is no loss, it is exempt. Remember, exemptions are a double-edged sword. It's great if there would have been a gain that is now exempted. It's not so good, as we've seen already in this lecture and before, if there would be a loss there. So in which case there is no allowable loss available. I buy it for 5, I sell it for 3. Although you've made a loss of 2,000, it's an exempt disposal. There is no allowable loss to set against any other gains. At the other end of the spectrum is that we buy it for more than 6,000, we sell it for more than 6,000. So neither cost nor sale proceeds are less than £6,000, in which case it's a normally calculated gain or loss that will then arise. So at the lower end, both figures are less than 6,000, exempt. Upper end, both figures are above 6,000, this is cost and proceeds there, by which I mean the gross proceeds. Then on that basis, it's a normally computed gain or loss. Most of the fun arises in terms of exam questions if one of the figures of cost or sale proceeds is less than 6,000 and the other figure is more than £6,000. How then do we deal with it? Right, the rules that you have to learn. Firstly, if you're looking at a gain situation, so you bought it for no more than £6,000, but you sell it for more than 6,000. Two calculations are now necessary. A normal calculation, so proceeds less selling expenses less cost, and that gives rise to the gain. But that normal gain is then restricted to a maximum. And we get this weird and wonderful calculation where we take a fraction, it is 5/3, times the difference between the gross proceeds and £6,000. So by however much gross proceeds exceeds £6,000, that excess times 5/3 is not necessarily the gain to use, but it is the maximum. Clearly, if that's less than the actual, you'll use the maximum. If the actual is lower, you will use the actual gain there. So only as a maximum gain calculation. And the final circumstance is it's cost more than 6,000, but it's sold for less than 6,000. i.e. there's going to be a loss. Well, where it was the other way around a moment ago, we limited the amount of gain that would be chargeable. Therefore, in this situation where you're looking at a loss, we limit the amount of allowable loss available to the taxpayer. And we do it in just one single calculation. Whereas this exercise demanded two calculations, actual gain, maximum gain, take the lower of the two. Here, one calculation where the rule with that is simple. You simply deem the gross proceeds to be £6,000. You deem the gross proceeds to be £6,000. Right, let's have a couple of little exercises on here, therefore, to test out these two rules. Okay, just go to a blank page, and you are told, we're told taxpayer sold a painting for £6,900, incurring selling expenses of £200. The original cost of this painting was £3,000. What you've got to do in an exam question, remember we're talking about chattels, so that's what's in your head. In an exam question, anything can come up, and you've got to have reference to all that stuff in your head. So what do you need to pick up on? Sold a painting. They don't say sold a chattel. Remember, there are special chattel rules here. No, you've got to recognise what it is. So sold a painting is a non-wasting chattel. Right, what do we sell it for? £6,900. What do we buy it for? £3,000. So we've got the situation where it was bought for less than 6 and sold for more than 6. How, therefore, do we calculate the gain? First, we do a normal gains calculation. So our normal gains calculation. Sales proceeds, 6,900, less selling expenses, what were they? 200. Take it away, net proceeds, £6,700. From net proceeds, we deduct our allowable cost. What was our allowable cost? £3,000. What therefore is the chargeable gain? Our chargeable gain is £3,700 using your normal gains rules. Right. But we recognise, because it was bought for less than 6 and sold for more than 6, and it is a non-wasting chattel, that there is also a maximum gain with which we must compare our actual gain and then take the lower of those two figures. The maximum gain. You have to remember this calculation, the fraction 5/3 times. Remember what we said? Gross proceeds. 6,900 minus the exemption limit of £6,000. So 6,900 minus £6,000, that's £900. Times 5/3, I've given you one that of course works out to a nice round number, 5/3 times 900, and that will be £1,500 there. 1,500. Is that less than the actual gain? That was 3,700. Yes, it is. So there you go. Your maximum gain is indeed going to be the gain now to be charged. It is 1,500 to pick up and include within the capital gains tax computation for the taxpayer for the tax year. If that actual chargeable gain, instead of being 3,700, had been something less than 1,500, you would simply have used the actual gain. Okay, that's the first of the two scenarios. The second of these scenarios is where, of course, we sell for less than 6,000 having bought for more. So this time we will tell you taxpayer sells a painting. Again, could be painting, antique, item of jewellery, whatever. Taxpayer sells a painting here for £3,800, incurring selling expenses, well, again we'll say of £200. Original cost is £7,000. Again, in an exam question, when you are asked to calculate what the chargeable gain or allowable loss will amount to, what do you need to do? You need to recognise it's a painting, therefore a non-wasting chattel. It's been sold for less than £6,000. It was bought for more than £6,000. Having recognised the situation that you're in, we then compute what will be the allowable loss. It's done in one calculation where we start off not with the actual proceeds, but with the deemed gross proceeds. And those deemed gross proceeds are £6,000. We ignore the actual and we deem the gross proceeds to be £6,000. Take away as its gross proceeds your selling expenses, 200, gives you net proceeds here of £5,800. Away from your net proceeds, of course, as ever we deduct cost, and our allowable cost was £7,000. Therefore, we have limited here the allowable loss to, well, 5,800 less 7 is £1,200. Okay, so in an exam question, pick up the fact that the asset being sold is a chattel. Is it a wasting or non-wasting chattel? If it's a wasting chattel, its disposal will be exempt. If it's non-wasting, your classic antique painting, work of art, a statue, whatever there, jewellery item. If it's a non-wasting chattel, then what was the cost? What are the gross proceeds? If bought and sold for less than 6,000, exempt. If bought and sold for both their more than 6,000, normal gains calculation. Much more likely it's one in the middle, where if we buy for less than 6 and sell for more than 6, do your normal actual gain, but then limit to a maximum gain calculation using the maximum gains calculation fraction there of 5/3 times the excess of the gross proceeds minus there the £6,000 limit. And finally, if we sell for less than 6, having bought for more than 6, there'll be a loss, but the loss will be limited. How do we do it? By deeming the gross proceeds there, by deeming the gross proceeds to be £6,000. If we now go back to our chapter, our note here, we now can see that we've got, following on from this, a little example 10. What I'd like you now to do, please, if you would, is to pause the lecture, have a go at example 10, check out your answer then with the, as we always do, the answers in the back, and then return, and then we'll complete our exercises in relation to this chapter. So pause therefore now. Okay, well, I left you with example 10 there. Hopefully you've checked it out, but just a quick run through and what we'd look at and determine on a first read through in an exam question. Got to work out the net gains or losses here in December 2016. First one, an antique table. Cost, oops, let's get the pen working. Cost 3,000, sold for 5,000. Both the cost and the proceeds are less than £6,000. Antique table, this is a non-wasting chattel. Bought for less than 6, sold for less than 6, it therefore will be exempt. Nothing to calculate there. In a written question, where this would be tested, of course, most likely tested, you would have to note that it was exempt. You can't just ignore. Next one, a painting, again a non-wasting chattel, cost £2,000, sales proceeds 10,000. Bought for less than 6, sold for more. Actual gain, 10 minus 2 is a gain of 8,000, subject then to the maximum gain calculation, where you would take 10,000 being the gross proceeds minus the 6,000 and multiply by 5/3. And that, I think you'd find in your answer, gave you a figure that was less than the actual gain of 8, therefore you would use the maximum gain figure. Next one, antique vase. Well, just like the painting, just like the antique table there, these are non-wasting chattels. Cost 8,000, more than £6,000, sold for 3,000, less than 6,000. Therefore, what do? We deem the gross proceeds to be £6,000. Nice and simple, there's no selling expenses in here to deduct. You would, because you deem the gross proceeds to be 6. So, gross proceeds 6, cost 8,000, capital loss £2,000. We limit, therefore, to that maximum loss, deeming the gross proceeds to be 6,000. Final example, vintage car. Go no further, car. A car, cars are exempt assets. Doesn't matter what the cost and the proceeds are, they are exempt. So there will be nothing to compute. So we'll just have to have computed what was the maximum gain on asset 2, and as we know, the allowable loss of £2,000 in relation to, I said asset 2 and asset 3, asset B and C there, as they are in that list. Hopefully then, not too many problems. Watch out though, again on that last one, if anyone was going to catch you, it might have been that one when you get stuck into sort of chattel mode. The £6,000 limit is irrelevant because we're talking about cars and they are exempt, end of story. Right. Now that takes us through to the last of the areas to look at in this chapter and the last real main computational problem in terms of calculating a gain, other than in one particular asset that will be the object of the next chapter, which is dealing with shares. But that awaits us, as I say, in our next lecture. What we're looking at here is other wasting assets that are not chattels. So they're wasting assets. Wasting, therefore, means that they've got a life of no more than 50 years. They're going to go down in value as they get ever closer to the end of their life. An example of one that is not a chattel, you might remember the chattel ones there, they were things like, remember what the wasting chattels were? Things like the racehorse, the greyhound, the yachts and other types of boat there. Example of a wasting asset that is not a chattel is a copyright there, like a patent, only to do with something professional, like a book or like a piece of music or something like a record. So, what will happen? If we've got a copyright, it would exist for a period of time. As that time ticks by and you get to the end of the copyright period where nobody else can use it, nobody else would be able to print that book other than with your permission and for which you would then be paid a copyright. As it gets to the end of that life, then of course you're in a situation where the value of that copyright goes down, because at the end of it, it's open access to all, and at that point in time, therefore, there would be no further value in that copyright. So, what have we got to do? The allowable expenditure here, so we again would know what the cost is deemed to waste away over the life of the asset. The point is that HMRC are going to reduce the allowable cost in the gains calculation we do. Because if over time, as we've just suggested, the value is going down, if we were simply allowed to use our original cost, if this is an asset that we had purchased, a copyright that we had bought, rather than that we had registered for ourselves, if we bought it, that cost is going to go down over time in terms of what we can expend against the sales proceeds. So we've got to have a way of depreciating that cost. Now the way that we do it is this. Firstly, when a disposal is made, the allowable expenditure, so our original cost, is restricted to take account of the asset's natural fall in value over time. As it gets ever closer to the end of its life, its value will go down. This fall in value is deemed to occur on a straight line basis over its predictable useful life. So, to compute our allowable cost, the original cost must therefore be reduced by. Now be careful, in some text you may see, here is a fraction that would be giving you, that's how you calculate the actual cost. What I'm telling you here is, we will pick up the original cost and we will reduce it by this calculation. Right, the reduction, therefore, the depreciation of this cost is what? We take, on the top line in this calculation, P, is the period of ownership of the seller. For how many years did we own it? Over what was the predictable life of the asset when it was acquired. And in most cases, multiplied by cost. C is the cost of the asset. But to make it a more interesting calculation, what they might do is to say that this particular asset has some sort of scrap or residual value at the end of the asset's predictable life here. In which case we take that away from cost. So effectively it is the net cost that we are depreciating. The original cost, what we pay for it, minus their any scrap value. Now this, I repeat, is the reduction. We reduce our original cost by this amount. So let's have a little look at example 11. Again, calculate the gain arising on the sale of the copyright. Business as usual. What did we sell it for? So we're told that we bought it on the 1st of December 04. It's a copyright. This therefore is a wasting asset, but it's not a chattel, not tangible movable property. Cost 25. Estimated useful life of 30 years. It is therefore a wasting asset. It's no more than 50 years. Estimated residual value of 1,000. But Z sold the asset for £38,000 on the 1st of December 16. So sales proceeds £38,000. If there were any selling expenses, we would then deduct those selling expenses outright in establishing our net proceeds. But we now need to deduct the allowable cost. Now our allowable cost, we'll look at the original acquisition cost that we were told it was bought for £25,000. But we're not going to now allow all of that cost against this value. Now you'll see here that although time has elapsed, its useful life is now a lot less than it was when we bought it. In fact, here the sales proceeds are bigger than the original cost. Now it may be because this particular copyright has become more valuable. There are more people interested in buying this particular book or whatever. Its value has gone up. Value is not just a function of time. But whether it's gone up or whether it hasn't gone up doesn't matter, because we still apply the same deduction in terms of that original cost to get our net or allowable cost here. Now look at the calculation that now we put through. We're going to reduce this. The reduction is by. Now again, let me just take you back to the calculation. I would like you to find these numbers, please. This information from the question here. P, the period of ownership of the seller. Bought 1st of December 04, sold 1st of December 16. That's a nice round number of years. Predictable life of the asset on acquisition, 30 years. C, the cost of the asset, 25,000. And S, the scrap value, 1,000. It's all there, just ready for you to pick up and put into the calculation here. So our calculation will therefore read, The amount of the life there, that the period of ownership of the seller, the bit by which it's eroded over our ownership, from 1st of December 04 to 1st December 16, that is 12 years. Its original life, 30 years there, times the cost was 25,000, but we're estimating a scrap value of £1,000, so we take away the £1,000. Right, put that through your calculator, 24,000 times 12 divided by 30. Now, do check it, but I made that, when I computed that figure, to be 9,600. That is the amount by which we reduce that cost, take it away from 25,000, and we've therefore got a net cost of £15,400. Deduct that, and you've got your chargeable gain. Here, that is going to be £22,600 as the chargeable gain. Again, the main thing to watch out for is the fraction that we use, the calculation by which we adjust up that original cost. That is a reduction. That is the amount by which we reduce that original cost. Okay, we've now seen most every circumstance in which you may be called upon to compute a gain or loss made by the taxpayer during the tax year. What do we then do? We net out the gains and losses of the year, get the net gains. Take away, if there are any capital losses brought forward, and then take away the AEA for the year. The taxable gain that remains would then be taxed at the relevant rate. So in calculating each of the gains, we also had to recognise the eventual tax rates that would be charged in relation to any gain. And we had to run separate analysis columns in terms of our gains calculations for residential property, for other gains, and then it wasn't applicable here because we haven't yet got to Chapter 14 and dealt with entrepreneurs' relief. We'd have another third column dealing with those gains that were eligible for entrepreneurs' relief, which then in their entirety, irrespective of the level of taxable income of the taxpayer, they would just be taxed at 10% if they qualified for entrepreneurs' relief. But that little pleasure awaits us in Chapter 14. So we would then be able to establish the amount of taxable gain on residential property, on other assets, eventually on assets eligible for entrepreneurs' relief. How do we do that? By deducting allowable deductions, losses and AEA, firstly from those gains taxed at the highest tax rates. What would that be? It will be residential property before other assets, before ER, entrepreneurs' relief qualifying assets. Once established, we could then use the relevant lower or higher rates appropriate to that type of asset. How do we know whether it was higher or there was still some lower rate to use? Based on the taxable income of the taxpayer off the income tax computation for the tax year. That would tell us whether any basic rate band remained. Go back, practice therefore those areas. As you can see there, you should now be able to attempt to practice question 29 and 30. Have a go at those, please. In our next chapter together, we will look at a specific problem that arises as regards computing gains or losses on the disposals of shares. Shares are a particular problem because if you acquire shares in a particular company, you may acquire them over an extended period of time and at different cost figures. I bought 1,000 shares in this company 10 years ago. I bought another 2,000 8 years ago. And so it goes on. Different numbers of shares bought over the history of buying shares in the company, and all of them at different costs. So the problem then, when eventually you sell some, but not all of those shares, what's the cost? If I'm not selling all of them, which shares am I selling? Because those I bought 10 years ago, compared to 8 years, compared to 5 years, compared to 2 years ago, compared to 6 months ago, they've all got different costs. So which costs am I going to use on these shares now sold? Do you think HMRC will leave it up to us to say which those shares are? No. So what there will be is specific rules by which we identify on a share sale which of the shares we have acquired over the lifetime of purchasing shares in that company, which shares are they, and therefore what is our allowable cost. Once you've got your allowable cost, it's business as usual. You've got your gain, and then you can proceed to include it within the net gains of the year and tax those net gains. The problem is working allowable cost. And that is the object of our next chapter together.